Morning, everyone, and thank you very much for joining. This is the morning market review with myself, Russell Shaw, the senior market specialist at FXCM. My email address is rshaw@fxcm.com, and today is Friday. It's the 19th. Just going to bring up our risk investment warning. I'll keep this on screen for a few moments. Just here is our market commentaries disclaimer. And just our references. Okay. What I'd like to do is just start off with the just go through to trading for a moment. And what you can see here in trading view is I think quite an interesting chart. So the bottom chart over here, this is our real interest rate that we've been looking at. So the 10-year minus the break even. The top chart is the 10-year, but it's actually minus the headline inflation, right? So, hey Ada, morning to you. Nice to have you at the webinar. And I just wanted to show something quite interesting between the break-even rate and the headline inflation rate. And there's still a huge there is a huge disconnect here, which is quite stark. So if we go through to say the 2011-12 period, so here is the 10-year minus headline inflation, and that seems to be pretty close to the real rate. There's a slight dichotomy, I beg your pardon, a slight dichotomy coming back to 2008, where the headline inflation is way more than the break even. But just going back in terms of the history, I don't have the break evens before 2003, but take a look at where we are right now, and there's just a huge disconnect here. You can see that the US 10-year minus the current headline inflation is minus 0.5, whereas we've got positive real rates according to the traded instruments. And that's just interesting because whilst the 10-year minus the 10-year break even suggests the real rate, clearly the headline inflation difference does not, and that obviously needs to be considered. If you are a central banker, you want to consider what happens if you start cutting rates. Now imagine you start cutting rates. So does that filter through to this kind of thought process? And what we can actually do is we can actually try and find some sort of core number here to see, well, what's the US 10-year minus a core inflation. Let's see if we can put that in. So we'll just go US CCPI, right? And let's take that off of the US 10-year. And we've still got rates, even on the core level, that are in fact negative. Real rates on a core basis are still very much negative. So what's the whole point about this is that I'm not of the opinion that the Fed can pivot. I think earlier in the week, I think it was a Tuesday, we looked at the Fed funds futures. We looked through to, say, April, May, June, around there should be some sort of pivot from terminal rate of around 3.6, and then it starts coming down. In order for that to really happen, okay, you would expect that the top chart over here has to be above 0, okay, because we are effectively in an environment where the policymakers have to control inflation. They have to control inflation because, number one, that's their mandate. That's what they exist for. Number two, the reason it's the mandate is because it is extremely dangerous if they don't. Okay. Now, yesterday something very odd happened in the market. I don't know if you guys caught it, but the Central Bank of Turkey cut interest rates by 100 basis points. Okay. Now, let's just take a look at the US dollar Turkish lira here. And what the US dollar Turkish lira has been doing is absolutely capitulating over the last year from about this period. Okay, so yes, the US dollar has certainly been strong, okay, against the US dollar certainly has been strong against the Turkish lira, but it was strong against any currency sort of out there from its besides these sort of perhaps the quantitative easing. Generally, US dollar has been fairly strong, and especially against these emerging market currencies. I mean, anybody that sort of follows the rand would know that. And of course, till about there, we've got, I would suggest, normal ebbs and flows. Normal ebbs and flows. A little bit of a rough patch here, okay, a little bit of a rough patch here. So there would be some sort of news story out there, but really, from this period here, it's just a circus. You can see that the Turkish lira has just absolutely capitulated, with regards to the US dollar, and the reason for that is there's huge political interference in the monetary policy decisions of Turkey. So when there's rampant inflation, a first year university student would be able to answer this in any exam question. When there's inflation, you would raise interest rates, and if you are the professor that is marking the paper, many of your students say, well, you would be lowering interest rates. Well, you would mark that question incorrect, because that is, of course, the wrong thing to do when there's rising inflation. Any first-year student that has passed Economics 101 will be able to answer that question quite confidently. But of course, that is not what's happening in Turkey. What they do is they are lowering interest rates in a global inflation environment for whatever reason. Now, they've also reaffirmed that they're going to be using the Turkish lira to promote commerce. So not only are you not fighting inflation, what you're doing here is that you are encouraging rampant inflation to the point that if the circus carries on, there's going to be hyperinflation. So if they carry on cutting rates, there's just going to be a capital flight out of the country. And what will happen here is that if you are a businessman in Turkey and you are importing goods, well, now you are paying price at a higher exchange rate, and of course you are going to have to pass that price on to your customers. So this is a very sort of extreme example of exactly why, it's a very extreme example, why the Fed would be very concerned with the headline inflation, is very concerned with the headline inflation taking your rates negative. Why would you want to? Why would the bank be concerned with that? Because there is a very again, economics 101. Any student that's doing first year economics in any university in the world will be able to tell you that monetary policy, okay, revolves around what's called a neutral rate, and the neutral rate, okay, is kind of where there is no inflation, and well, not no inflation, there's no excess inflation. So you're kind of at that Goldilocks economy where you manage to grow at your target rate, and prices are fairly stable, economic activity is fairly stable, and that's what we call R star. Okay, that's what we call R star. R star is effectively your neutral rate. If you can determine what your R star is, you can actually conduct monetary policy. Okay. In other words, if you raise your rates above R star, if you raise it above, and that would be acceptable in an inflationary environment, that would be contraction. Okay, you would be contracting the economy in order to control your inflation. So that would be effectively why you've got to identify your neutral rate. And what you would do is you would then move rates above neutral to try and bring your economy into target. If you had an economy that needed to be stimulated, you would drop rates under your neutral rate, because that would be expansive. So that's why we talk about a neutral rate. So what you do is you try and figure out what your R star is, and then manage your economy according to that. So what is R star? So R star, the way that we determine it, just sort of at a very basic level, is we try and find sort of an average growth trend, an average growth rate for the economy, average growth, which let's just say is 2%. Let's just say it's 2%. And what you would do is you would add on your target inflation rate. So let's say you're targeting 2%. Well, what's your R star then? Okay, well then R star should be roughly 4%. Okay, so if your R star is roughly 4%, these are obviously assumed numbers, right? Then of course you'd move your bank rate above 4% to contract. You'd move your bank rate below 4% to expand, and that's effectively what the Fed is looking to do. They're looking to get to that R star and move slightly above it. So the idea here is the US 10-year minus the core or the headline, that's still negative. So I don't think we can get that monetary policy pivot that seems to be a theme in the market. Well, it is a theme in the market because we've seen the Fed funds futures, and the Fed funds futures are telling us, well, there's going to be a pivot. So if we kind of go to Z, is it ZQ, I believe, is that right? And we go through to, let's go through to say May. Okay, so this is the May Fed funds future, and you can see it's at 96,325. So what you'll do there is you'll take 100 and you would subtract 96.325, and that gives us an interest rate of 3.68. I'm rounding off 3.68. Now that's interesting because on Tuesday it was 7 basis points lower. So already the Fed funds futures are starting to adjust for higher terminal rates going forward. Just over the last 3 days, we've seen some movement there. Let's go through to the next one. So let's go through to June. Okay, and then here's the pivot. So between May and June, there's going to be a pivot from from contractionary policy to expansionary policy. So where it was 3.68 come May, it's 3.63 come June, but it's already higher. It's already higher than it was at the beginning of the week. So the Fed funds futures are really starting to adjust for this kind of battle against inflation. Let's just take this to another level, and then we're going to start doing some analysis based on this. So just bear with me one moment. Let's go back to that headline inflation. So I'll just bring in inflation. Let's take a look at inflation year-on-year in the US. Okay, so let's just bring this back in. And what we have here is moderation. So we dropped from 9.1%, we dropped down to 8.5%. And we know that from last week. The core, I think, was roughly stable around 5.9, but the market celebrated this moderation here. So why would, and I think that we would probably have seen Fed funds futures come down sort of after that, but why are they moving back up? Or why are they suggesting a higher terminal rate into May next year? And I think something that we need to start keeping an eye on is now something called the median CPI. This comes out of, I think it comes out of the Federal Reserve of Cleveland. We're always looking at the Federal Reserve of St. Louis, but Federal Reserve of Cleveland calculates what's called the median CPI. So let's just bring that in. You can see that your inflation is coming down here. In fact, let's just bring in US CPI. Okay, so let's just look at it on a CPI basis on a year-on-year. No, this is the median. This is the median. This is the one I wanted to show you. All right, let me just try this once for US CPI. Okay, bear with me a moment. Just bringing up the rate of change. We're looking at a monthly scale. So just make your rate of change 12 to get a rate of change over an annualized period. Yeah, there we go. All right, good. And this is effectively your rate of change of your CPI. This is what we get. This is what we get released. So when we see the release of the CPI, they're giving us this rate of change of the actual series, and you can see that it's moderating. Yeah, you can see that it's moderating here. Cleveland CPI does something quite remarkable. They calculate something called the median CPI. The median CPI. Now this I think is sort of a hidden story. So let's just bring up US CPI again, but this time we're going to bring up the median. Okay, the median year-on-year, and let's bring that underneath. And this I think is a hidden story. Okay, so let's change this to a. Let's just change this to a red. All right, and let's hide this one away. So here we've got two CPI series. We've got the just your headline, okay, and we've got this thing called the median. Now, moderation is in the top. No moderation is in the bottom. So what am I showing you here? So let's just unpack this. So what happens is the CPI basket is going to be made up of a basket of goods. So some of those would be based on energy. Some of those would be based on food prices. Some of those would be based on rent. And the formula would aggregate all of these and come out with some sort of denominator, and you would get your headline number. So you would have kind of all these kind of prices over time. Okay, so would have time, and you would get your headline CPI. What the median does, the median's just looking at the middle. That's what it's doing. It's not looking at your extremes. It's not looking at your outliers. So to give you let's just say you've got a figure of 1, 2, 10, okay? And I had to say to you, what's the average of 1 plus 2 plus 10, okay, which is 13, and you would, I'd say, what's the average? And you would tell me, well, it's 6.5. Okay, that's your average. Now, the reason that it's 6.5, okay, the reason that it's 6.5 is because of the influence of the number 10. Your first two numbers are 1, 2, okay, and then you've got a massive jump to 10, which actually takes your average up. There's a huge influence on the average by number 10. 10's an outlier. It certainly doesn't sort of gel with the first two numbers. So is the 6.5 realistic? Of course, and I'm only using a sample size of 3, so there's no real trend here. But what the median would tell you is the median would say, well, hang on a second, we're not going to look at the average. What we're going to do is we're just going to take the middle, the very middle, and we're going to use that. So the median here is 2. So your median is a lot lower than your average, and the reason that it's a lot lower than your average is simply because it's not influenced by your outlier. It's not influenced by your outlier. So now the question is, how are outliers affecting the CPI? Okay, so how are outliers affecting, and are outliers coming down, and is it the influence of the outliers coming down that has been the reason we've seen moderation here? And I would suggest that is probably the reason, because your median is still going up. It's still rising quite dramatically. So the longer that your median stays moving up, the harder it's actually going to be for the full series to come down to 2%, because at some stage your median is going to stop the process. It's going to halt the process if it doesn't start moderating. So we've got to start looking at the median, the middle. Unless that median starts coming down, the Fed's not going to make much progress. That's what we call sticky prices, sticky inflation. And although the price of energy has come down, price of food, not really. Price of rent, not really. So you've got to see a median starting to come down. You start seeing the median coming down, then I think the monetary policy probably is starting to do its work. So the transmission mechanism is starting to work through the economy. But I think until the median starts coming down, that's going to be a big concern, because it's indicating what we call sticky inflation. Okay. Sorry. Gurdeep has corrected my mathematics. So let me just correct this. He's quite correct. I took 30 divided by 2, which is incorrect, because we've got 3 three variables, it would be 30 divided by 3, which I'm begging your pardon, would be 4.33. But the point being that the 10 over here pushes the whole average much further out. So we just sort of look at the middle. So you're quite right there, Goody. My apologies. I, again, would attribute this to my foggy thinking this week, and I would duly apologize. But thank you very much for pointing that out. Textbook argument between union members and management, which average? Sure, exactly. But the point being, okay, the point being that the outliers have undue influence on series. The median is not affected by that. Outliers would have undue influence on the, let me rephrase it, outliers would have undue influence on the average of the series, okay? The median doesn't do that. So now we want to just keep an eye, okay? Oil would be an outlier, yes, of course. So oil has obviously come down. So that would be one of the reasons that we've seen that moderation in CPI. Exactly right, Anna. So the idea is, well, wait a second. Is the median part of the basket actually starting to respond to monetary policy? Now, if it doesn't respond to monetary policy, well, then you can't do that. You can't do that pivot. You can't do that pivot, right? Because the idea is you're still going to be battling. You're still going to be battling inflation, and you'll be able to apply a median to the core number as well. You'll be able to apply a median to the PCE. In fact, I think there is something called a trimmed PCE. Let's just take a look at that. I just seem to recall I've come across it before. Let me just see it. United States PCE. Just want to see if there's a median. Hang on. It wouldn't be. I think it's called trimmed. Trimmed. Yeah. So you've got here. I don't see the trimmed PCE, but so what the trim does, it's similar to the median. It's not quite the same. The median is just taking the middle. That's all you do. You're taking the middle, and what a trimmed series is. A trimmed actually would cut off the extremes. Or cut off the extremes. It would choose what percentage of the tails they want to cut off, and then whatever's left over, they'll work out the average. So that's what a trimmed series is. So we want to just keep an eye on this. So what's the whole big deal? Like we've been talking about this for quite a long time. How does that help us as traders? It's something that we need to keep an eye on because it's going to affect monetary policy, and monetary policy is, of course, the movement of interest rates. And we spoke about the interest rates yesterday, where, well, our interest rates effectively going to be moving up or down. So the real rates is effectively, but what Anna brought up yesterday was very important. What about sort of the risk-free rate? So that risk-free rate is affected by the real rate, right? So risk-free, which is including an inflation adjustment, is affected by the real. So as long as the Fed is worried about that inflation, and I think a good way for us to monitor it is by using a median here because of these outliers. Well, then, are we really going to see a moderation in the risk-free rate, or are we not going to see a moderation in the risk-free rate? Because this is where it now becomes important for us as traders. Number one, the time value of money. So we know that any sort of cash flow, I'm just going to put cash flow or think about it as a dividend. I just go 1 plus, we'll call it interest rate. Let's call it interest. Okay. So if this component interest doesn't moderate, if the interest doesn't moderate, then the discounting factor or the calculation of calculating present values isn't going to change, And that means that the rally that we've seen over the last week may be sort of a bear market rally, because now we're starting to see those interest rates, the Fed funds futures, starting to tick up. Well, if they're starting to tick up, okay, that's really important for us, because let's just bring up the DAX. I don't want to look at Bitcoin, I beg your pardon. We'll do that on Wednesday. But we take a look at DAX. Well, maybe last week's movement up was based on a false premise, because that interest rate maybe isn't going to respond unless we start seeing that median starting to come down, and it's not starting to come down yet. So that's maybe why we see some red this week. Go through to the US 30. Okay, this is odd. The US 30 here certainly holding up better than the DAX. But if we just take a look at the sentiment for this week's candle, so let's just try and understand what's happened this week. This week you've had a huge bullish push all the way up to the high for the week, but then what happened is that the bulls lost control and has been pushed back down. So the bulls have lost control. The bears haven't taken over control just yet, but this over here does have a selling tail, and it looks almost uncertain. It's got that spinning top aspect to it, doesn't it? So some sort of uncertainty creeping in on the US 30. The DAX started to show resistance at this 62% retracement, and the question is this temporary? Do we actually break through the 62%? Does the stock market carry on going up? And I think it very much is how one would view the Fed's stance on monetary policy. And I think that the moderation in the headline inflation last week, sort of an optical illusion, because that median hasn't really shifted yet. So we just want to be careful of that. It flows through to other instruments as well. So let's just take a look at euro. So I am short euro. I told you guys yesterday that I took a short position in euro. I'm still holding it. But of course, if the US Federal Reserve is going to maintain its hawkish policy, and again, that's a big if, it depends really how the transmission mechanism works of interest rates. Do we see that median starting to roll over? That would change the analysis. But right now you can see how just over the last week the euro has capitulated to the point now we're getting to a really interesting area where the daily has moved into this lower quintile again, and I think that the 1-for-1, the parity level, I think that's now in real danger of finally sort of slipping. We just want to keep an eye on that. You go through to the US dollar. Okay, US dollar is making its way back. Okay, it's making its way back to upper quintile here. So you can see that we've got some very interesting price movements here. Let's just go back to trading view just to round things off, and then if there's any questions, of course, I'll take them. But let's just go back to the way we've been looking at the market, because I think that's a fair way of looking at the market. So let's just go through to US 10-year minus the break even. Okay, and it's just what's going on here. Haven't quite got it right in. It is 10-year minus break even. Aha, there we go. Okay, so this will make more sense now. What am I doing wrong here? US 10-year minus. All right, sorry, I got fat fingers at the moment. There we go, that's better. All right, this should make sense. I know what I'm doing wrong. I'm putting it in the, I've got a hidden chart here, which I collapsed. That's what I was doing wrong. I forgot that I'd collapsed the CPI series. I figured if I had finally figured it out. Okay, there we go. All right. All right, so here is our here's our real rate. Okay, here's our real rate, and yeah, we can definitely look at cable. Absolutely. Let's lump it all together. I think all this analysis sort of has a natural flow over. Okay, so here's our real rate. Now let's just put the dollar underneath. All right, and here is, I think, the first part of the analysis. I'll add cable underneath this. So we're looking to see if this is a trough, and I think that it could be, just based on the stickiness of inflation. Of course, I'm going to tag on that subject to correction, right? So I'm just going to tag that on, and then you can see that it looks as if the dollar market is sort of anticipating. Now, we just want to keep an eye on this, because if there is a change up on the real rate, I think then it does, of course, flow through to the US dollar. But I'm not sure the US dollar is done yet. And the reason I don't think the US dollar is done yet, I'm not sure the Fed's done yet. So we want to just keep that in mind. And if the Fed's not done yet, of course, then the risk markets still have inherent risk associated with them, don't they? So you want to be very, very careful with that. Let's add cable underneath this, and it's just asking if we can take a look at that, and we certainly can. So I'll just add that underneath this. Okay, cool. And what we can actually do, just to sort of, let's actually take the dollar out. Let's take a look and see what the real rate is relative to cable, and then we'll just discuss it, because of course the inflation rate in the UK is monstrous at the moment. So let's just take a look at that. All right, so the cable pairing has quite a strong inverse correlation to US rates. So the argument would need to be made there that despite the Bank of England's efforts, a large part of cable's movement is actually based on Fed policy. I'm not sure if that's a fair assessment or not, but the way that I think the correlation coefficient is lining up is just very interesting, given this is when QT was confirmed. Okay, this is kind of when QT was confirmed. So the idea here is QT kind of the driver of the market, and what does that mean for Bank of England policy? I don't think it means anything in terms of Bank of England policy. Bank of England is going to increase their bank rate by 50 basis points. I think it's at 1.75 now. They'll increase it to 2.25 in September. What does that mean for cable? I'm not sure it means that it's going to influence the direction of cable all that much. In fact, if we let's take out the correlation coefficient, because I'm going to go to the daily. In fact, here is the sort of here is the inflation spike here. There's the inflation spike here. Okay, and then it gets faded very, very quickly. See, it gets faded very, very quickly. I think that we're in a very, very complex situation globally. I think we're in a madly complex, and I think it's because of just this rampant inflation. All central banks fighting the same war. I'm not sure any one of them is on top of it at the moment. But you can see that certainly, according to the correlation coefficient, there is an inverse relationship here. Now, a word of caution with the correlation coefficient. We've got to make fundamental economic sense of why would the US real rates be affecting cable. And I don't think they are. I think they're affecting the dollar. And I think that's affecting cable because, of course, cable's made up of two currencies as a pairing, right? One would be sterling, one would be greenback. So that's the sort of, I think that's the causality there. So it's kind of A is being influenced. Sorry, B is being influenced by A, and C is being influenced by B. So there's kind of that indirect type of relationship which is potentially taking place here. With that, I think in effect is the analysis. By the way, of course, the lower cable pairing is not great news if you're fighting inflation. If you are importing, because it means you're importing at a higher price. The difference between the Turkey situation and the BOEs, the BOEs doing everything correctly. The Central Bank of Turkey is doing everything incorrectly. It's completely unfathomable. I can't fathom it. It's ridiculous. It's a circus. It makes zero sense. All right. Gertie writing, BOE passing the baton to Fed headline yesterday, and is saying feels like the end of the world. So we want to see food prices starting to come down, and again, I think a lot of that would be supply based. So I'm not sure what effect interest rates have. I think they would have some effect. I mean, so they would have some sort of demand influence. Some sort of demand destruction influence on food. People would be looking for perhaps more affordable food, sort of budgeting around that. But I think a large part of that's also going to be based on the supply side and just seeing if that corrects. You've also got these ridiculous energy costs still. I think that, I'm not sure oil, by the way, I'm not sure that story is done yet. You know, we've got to, I was just listening to an interesting interview on Bloomberg Surveillance yesterday by one of the Bank of America analysts who specializes in energy, and he had some really interesting things to say about oil, and he expects it to move back up. If you're interested, just go to your podcast platform. Just listen to yesterday's Bloomberg Surveillance. It was very, very interesting. All right, I think we can kind of stop there. If there's any questions, please go ahead and let me know. Any questions? Type this in. I feel that we had a better webinar. I'm feeling that I'm coming out of this sort of fog that I've been in for this week. So thank you very much for your patience. All right, guys, have a good weekend ahead, and then we'll chat on Monday. Thank you very much. You too, Anna. Have a great weekend. Cheers.